Now, let's talk about the second trade that I took on Thursday, which ended up being a losing trade. Now, first of all, as you guys know, I provided you with a trade signal for this particular setup, and along with that, I specifically mentioned to take lower risk on this trade because it was a counter trade against the higher time frame drawn liquidity. Now, this is something really important to understand because if you're taking a counter trend trade or a retracement trade against the drawn liquidity, then your risk on those sort of trades must be lower. Ideally, it should be half of your normal risk, meaning half of what you usually risk on trades that are aligned with the high time frame drawn liquidity. You also need to remember that if you are a beginner or even an intermediate trader, then you should avoid taking these sort of counter trades, right? Your priority should always be to avoid taking counter trades, right? You should stay away from these sort of trades at all cost because they are risky as compared to those trades that are aligned with the high time frame drawn liquidity. The only reason I took this setup was that I had a strong narrative, a strong conviction, and a solid market context backing up my idea. Now, let's break down exactly why I took this trade in the first place. On Wednesday, you will remember that on the daily time frame, I gave you this daily fair value gap as my drawn liquidity, and my expectation was that price would eventually reach this daily key level. Alongside that, if you look at the price action since Monday, right, since from here, you would see that price had been steadily pushing higher, right, expanding for over 400 pips, right, over 400 pips from the start of the week, right. Now, typically, when price moves this aggressively in one direction, it doesn't just keep pushing endlessly without a retracement. almost Almost every single time you'll see that price eventually pulls back before continuing in the original direction, right? This is a pattern that repeats over and over again, right? The markets doesn't move, or the markets don't move in a straight line. They follow a rhythm of expansion, then retracements, then another expansion, right? This is what we call market profiles. If you look at this price section right here, or any price section in the charts, you will see that markets always follow a pattern of expansion, then the retracements, then expansion, and then retracement, and then expansions, right? And for this particular reason, after we had this huge expansion of over 400 pips, I was expecting price to have a small retracement on Thursday, right? Before we continue moving higher towards this daily fair value gap on Friday, right? Based on weekly profiles and market profiles, my expectation was for price to pull back before continuing higher on Friday. And that's what led me to anticipate a short trade or a bearish trade on the lower time frame for a possible retracement. Now, another key factor in my analysis was an SMT divergence that we formed during the London Open between EU and DXY. And what happened is that during the London Open session, DXY tested this daily fair value gap that it had on its chart, right? But EU failed to test its corresponding daily key level. And this created a clear key level divergence, right, which signaled a possible short-term shift in price action. And because of this, I believe that we had enough market context to frame a retracement trade on the lower time frame, right? So at this point, my narrative for price was strong. We had an SMT divergence with DXY, a key level SMT divergence with DXY, and based on market profiles, I was expecting price to at least retrace before we could continue moving higher on Friday, right? I had multiple factors lining up for a potential retracement, right? And that was enough narrative and market context for me to frame a short setup. But also at the same time, my risk on that trade was lower because it didn't had the first key aspect aligned with it, which is the directional bias, right? If the directional bias isn't aligned with the trade or the trade idea, then your risk must be half of what you usually risk on other normal trades. And if you go back and study the charts, you will find many examples of this exact pattern repeating over and over again. When we have an expansion, almost always we have a retracement before we continue moving higher or lower, right? This is market profile, right? You can see this daily bearish candle and this daily bearish candle towards this key level right here, you can see, and we had this turtle soup, and then we expanded higher again, we had a retracement, then higher, then a retracement, then higher. This is what we call market profiles, right? Now for those of you who are currently in their amateur phase in trading, I want to make something very clear. Now, even though I framed this setup correctly using my experience, knowledge, and my trading approach, and it still ended up being a losing trade, it doesn't mean that it was a bad trade, right? It wasn't a bad trade at all. Based on my rules and protocols, this was actually a good trade in terms of probability and setup quality, right? The market simply didn't respect the level this time and continued moving higher instead. And that's completely okay because I know that my edge cannot be 100% right all the time, right? I know that trading is about probabilities and not guarantees, and losses are just a natural part of the process. What is a big deal is how you handle those losses and whether you learn from them or not. And when I'm trading, I never actively think about winning or losing. All I care about is correctly following my plan because I know that if I stick to my system, the profits will naturally follow. And let's be clear, correctly following your plan does not mean that you will never take losses, right? Losses are a natural part of trading and they are inevitable no matter what sort of strategy or system that you have. And what matters is that you only take valid losses, right? Meaning losses that are aligned with your system and your trading edge, right? Those are the only type of losses that you must take. And any other loss apart from that is an invalid one that you must avoid. And if you take them, then that's your fault and that's a mistake on your part. But if you take a loss that is a valid one, right, meaning it followed your system, you correctly followed your plan and your trading model, and it still ended up being a loss, then that's a completely valid loss that you shouldn't worry about or panic about. The real problem isn't losses. The problem is taking unnecessary losses that aren't backed by your system, right? The real problem is taking random trades outside of your plans and letting losses affect your emotions and your future trading decisions. That's what the real problem is. The real problem isn't taking valid losses. Instead, they are completely normal. They are inevitable and you should accept that. Right? And the way you develop the right trading mindset is by gaining a deeper knowledge and a deeper understanding of risk management and risk to reward ratio. And then that way you will never feel scared or afraid of a loss again, right? When you fully grasp the power of proper risk management, then you will never feel worry or you will never panic when you face a loss or experience a loss or lose a trade. Let me give you an example. Personally, I trade with a 3-to-1 risk to reward ratio, right? That means that if I lose 70 trades out of 100, I would still be profitable. Think about that for a second. Even with a 30% win rate, right? I have a 1 to 3 risk to reward ratio. And this means that even with a 30% win rate, I'd still be making money with this sort of risk to reward ratio, right? If I lose 70 out of 100 trades and win the rest of 30 trades, I'd still be profitable if I have a risk to reward ratio of 3R. That's the beauty of risk management. And when you are actively thinking about it and you are aware of this beauty or these intricacies of risk management, then you would never feel scared or you would never worry about a loss ever again. Now, if you use candle ranges in your trading, you can push your win rate above 60%. So imagine your results with that kind of probability on your side, right? But even at a 60% win rate, you'll still lose 40 out of 100 trades or 400 out of 1,000 trades, right? And yet, despite those losses, you'll still be profitable in the long run because you know how to manage risk and you know about risk reward ratios. But if you are letting, but if you let those losses mess up with your performance and mess up with your decision making process, then obviously that would not be the case. And in the long run, you won't be profitable. Some of the best traders that I've ever seen have a win rate of 50 to 40%, meaning that they actually lose more trades than they win, but they are still highly profitable and they make millions. You know why? Because they understand that losses aren't the problem. The real problem is how you handle and manage those losses. And they know that in trading, you should never chase perfection. And instead, their whole focus is on discipline and consistency and following their system accurately. Right? This is what they've mastered. They haven't mastered wins, but instead, they've mastered the art of handling and managing losses. Right? And that's what you need to master as well if you want to become profitable. Now, regarding this particular trade, you can see that on the daily time frame, I saw that the market was overextended after a 400 plus pip move up, right? And because of it, I was expecting a retracement before we could continue moving higher. And then on the 4 hour time frame, we had formed this candle range just below this daily key level, and I expected price to take out this candle range and test this daily key level and then reverse into this 4 hour fair value gap, meaning that I was expecting a retracement. But what happened is that we took out this candle range, but then we had an SMT divergence with DXY. DXY tested this key level, but EU failed to test this key level, which increased my conviction in this trade idea even more, right? So you can see that I had the SMT divergence, the 4 hour candle range, and the Thursday retracement weekly profile all in play, right? And all of those key supporting factors and all of those key aspects were signaling towards a short setup, right? And because of it, I went down to the 15-minute time frame, and after we formed this order block right here, this order block, I took an entry at the open of this order block with my stop loss above the order block's high, and I targeted these equal lows and eventually this low right here is my target. But despite having a solid plan and a solid narrative behind this trade, price eventually continued higher, right? Continued higher, invalidating this setup and losing the trade. And that's okay because this loss was a valid loss within my system, right? Now, let's talk about the lesson that we get from this loss. Even though this was a valid loss, there's still an important lesson that you can take away from it. And that is that when price forms a lower time frame entry at a key time, right? When price forms a lower time frame entry at a key time and takes out a candle range, you typically expect it to expand immediately with momentum like this, right? When price forms a lower time frame entry, you typically expect it to expand immediately with momentum and a short amount of time or in a short period of time. But if price instead hovers around the entry, consolidates and ranges and does nothing, then that's often a warning sign. And in this particular trade, you can see that price ranged around the entry, doing nothing instead of expanding downward right away. Right? And that should have been a signal for me that the bearish momentum wasn't strong enough and I should have considered re-evaluating my short position, right? And additionally, we had a red folder news event on the calendar, right? Meaning that a manipulation was highly likely. And these two key factors, price failing to expand immediately and the upcoming high impact news event, the potential manipulation, should have triggered my focus and made me more cautious. But in this case, I overlooked them, and that's a lesson for me to carry forward in my trading, right? When a lower time frame entry forms at a key time after a candle length get purge, you expect it to expand immediately or reverse immediately towards your target. But if it doesn't, like the other trades that I showed you, then that's a warning for you that maybe the bearish momentum isn't strong enough and you should reconsider reevaluating your position. In this particular example, I overlooked these key factors which led to this trade being a loss. But this is a lesson for me that I will carry forward and that I will put it in my notes and journal it, right? And I will learn from it. And see, that's how you handle a loss. You learn from it instead of panicking about it or worrying about it.